Your credit score. It's the number everyone talks about. It's the number you check on your phone. It's the number you're worried about every time you walk into a dealership. But here's what most people don't understand. Your credit score means something very different to a subprime lender than it does to a prime lender. And if you don't understand the difference, you're walking into the dealership blind. I'm Gary, the bad credit car guy, 26 years as a general manager of an independent used car dealership. Thousands of subprime deals personally closed. In this video, I'm going to break down exactly what your credit score means in the real world of subprime auto financing, what the tiers are, what happens at each level, and what even a small improvement in your score can do to your deal. By the end of this video, you're going to understand your score in a way most people never do. Let me start by laying out the 4 credit tiers that matter in auto financing. These aren't textbook definitions. These are the real-world ranges I worked with for 26 years, sitting across the desk from lenders and customers every single day. Tier 1, prime credit, 700 and above. This is excellent credit. If your score is 700 or higher, you qualify for prime financing. You're going to get the best interest rates, the most flexible loan terms, and the easiest approval process. Most major banks and credit unions are competing for your business. This is not the audience I make content for, but I mention it so you understand where the top of the ladder is and what you're working toward. Tier 2. Secondary, 600 to 699. This is the gray zone. You're not prime, but you're not deep subprime either. At this level, you can still get financed. And depending on the rest of your credit profile, you might be able to get rates that are close to prime. Some traditional lenders will work with you at the higher end of this range. At the lower end of this range, you're starting to work with subprime lenders. Secondary buyers often have some credit challenges, a few late payments, maybe a collection or two, but nothing catastrophic. Tier 3. Subprime 520 to 599. This is the core of what I do and the core of who I make content for. If your score is in this range, you are a subprime borrower. You can absolutely get approved for a car loan, but it's going to require the right lender, the right vehicle, the right down payment, and a clean, accurate credit application. Your interest rate is going to be higher than a prime borrower. Your terms may be more restrictive, but there are lenders who specialize in exactly this tier, and deals get done here every single day. Tier 4, deep subprime, below 520. This is the most challenging tier. Below 520, your options narrow significantly. The lenders who work in this space are specialized. They're going to want to see a stronger down payment, often 20% or more. They're going to look very carefully at your recent credit history, your income, your stability. It's not impossible to get approved at this level. I've closed deals at this level, but it requires everything to line up. Your application has to be clean, your income has to be solid, and your down payment has to be strong. Now that you know the 4 tiers, let me tell you what they actually mean for your deal. Here's how these tiers actually play out when your deal hits a lender's desk. Every subprime lender has what's called a buy program, a set of guidelines that tells the dealer what deals they'll approve and under what conditions. Those buy programs are built around credit tiers. A lender might say, for a Tier 3 subprime borrower between 520 and 599, we'll finance up to 80% of the vehicle value. We want to see at least 15% down, and our maximum loan term is 48 months. For a Tier 2 secondary borrower between 600 and 699, that same lender might say, we'll finance up to 90% of vehicle value, 10% down is fine, and we'll go up to 60 months on the term. See how the tier directly affects the structure of your deal? Your score doesn't just determine whether you get approved. It determines how much they'll lend you, how much down they want, how long they'll give you to pay it back, and what interest rate they'll charge. This is why I always tell people, your credit score is not just a number. It's the starting point for every other number in your deal. And here's something most people don't think about. The difference between a 598 and a 620 isn't just 22 points on a scale. It's the difference between being a Tier 3 subprime borrower and a Tier 2 secondary borrower. That 22-point difference could mean a lower interest rate, a longer loan term, a lower monthly payment, and a significantly easier approval process. That's why working on your score, even a little bit, matters more than most people realize. Now I want to make an important distinction that most people miss: the difference between your credit score and your overall credit profile. Your score is a number. Your credit profile is the full story behind that number. And in subprime auto financing, experienced lenders and finance managers read the story, not just the number. Here's what I mean. I've seen a borrower with a 580 score get approved over a borrower with a 610 score. How? Because the 580 borrower had clean recent history. Their last 12 months of payments were solid, their situation had clearly stabilized, and the challenges on their bureau were old. The 610 borrower had a higher score, but their most recent activity showed fresh lates and a pattern of inconsistency. Lenders care about trajectory. Are things getting better or getting worse? A lower score with an upward trend tells a better story than a higher score that's heading in the wrong direction. They also look at what's causing the low score. A medical collection from 3 years ago that you couldn't control is a very different situation than a pattern of missed payments across multiple accounts over the last 6 months. Same score, very different story. This is why I always tell my audience, don't just focus on the number, focus on the story your credit is telling. Because that story is what a good finance manager is going to use to go to bat for you with a lender. There's one more credit situation I want to address, and that's what's called a thin credit file. A thin credit file doesn't mean bad credit. It means not enough credit history for lenders to get a clear picture of you as a borrower. Maybe you've never had a credit card. Maybe you've always paid cash for everything. Maybe you're young and just starting out. Lenders treat a thin file differently than they treat bad credit. With bad credit, there's a story, and sometimes it's a story you can explain and work around. With a thin file, there's no story at all, and some lenders are actually more uncomfortable with no story than with a difficult one. If you have a thin credit file and you're trying to get a car loan, here's my advice. Be prepared to make a stronger down payment. Look for lenders who specialize in first-time buyers or no credit situations. And after you get this car loan, make every single payment on time, because this loan is going to be the foundation of your credit history going forward. Treat it that way. Let me finish with something practical. What actually moves your credit score and how fast? Your credit score is made up of 5 factors. Payment history is the biggest one, about 35% of your score. That means making payments on time is the single most impactful thing you can do. Every on-time payment helps. Every late payment hurts. The second biggest factor is credit utilization, about 30%. That's how much of your available credit you're using. If you have a credit card with a $1,000 limit and you're carrying an $800 balance, that's 80% utilization and it's hurting your score. Get that below 30% and you'll see your score move. The other factors, length of credit history, credit mix, and new inquiries, make up the remaining 35%. Don't open a bunch of new accounts right before you try to get a car loan. New inquiries temporarily lower your score. Here's the honest truth about how fast scores move. Small improvements, 20 to 30 points, are achievable in 60 to 90 days if you pay down balances and make on-time payments. Larger improvements take longer. Don't let anyone tell you they can fix your credit overnight. They can't. But consistent positive behavior moves the needle faster than most people expect. And remember what I said earlier. Even 20 to 30 points can move you from one tier to another, from deep subprime to subprime, from subprime to secondary. Each step up that ladder changes your deal. Your credit score is not a life sentence. It's a snapshot of where you are right now. And the more you understand what that snapshot means to a lender and what you can do to improve it, the better position you're in to get the car you need and the deal you deserve. I'm Gary, the Bad Credit Car Guy. Everything I put out on this channel comes from 26 years of real experience on the dealer side of this business. Not theory, not generic advice, what actually works. In the next video, I'm going to talk about how to find the right dealership when you have bad credit. Because not every dealer works with subprime lenders, and walking into the wrong one wastes your time and costs you a hard credit pull. That's coming up next. Grab the free guide in the description, The 7 Things Dealers Check Beyond Your Credit Score. It goes deeper on everything we talked about today. Subscribe so you don't miss the next video. Drop your questions in the comments. I read every one. I'll see you in the next one.